Hello and welcome to our podcast, where we discuss the latest in crypto and blockchain. I'm Jane.
And I'm Nike. Today, we're going to talk about the latest news in the crypto space, which is the upcoming Arbitrum token airdrop.
Yes, Arbitrum is an Ethereum Layer 2 scaling solution, and they are launching their token airdrop on March 23rd. This has caught the attention of many in the Web3 community. To begin with, let's tell the audience a little about Arbitrum.
Arbitrum, one of the Layer 2 scaling solutions built on top of the Ethereum network. It has been gaining a lot of attention recently due to its upcoming token airdrop.
Yes, that's right. But there's more to Arbitrum than just the airdrop. One of the most significant advantages of the Arbitrum network is the ability to conduct transactions at a much faster speed and with lower fees than the Ethereum network.
That's right. And there are various ways to make money with Arbitrum, which includes earning yield, trading tokens, staking, and providing liquidity.
Let's break it down further. Firstly, you can earn yield by using the Arbitrum bridge to transfer your Ethereum tokens to the Arbitrum network. Once your tokens are on the network, you can deposit them into yield-generating protocols such as AAV, Compound, or Yearn Finance. So, APY rates for AAV on Arbitrum is up to 5.46% and Compound is up to 4%.
Secondly, you can trade tokens on the Arbitrum network just like any other cryptocurrency. By leveraging the faster transaction speeds and lower fees of the network, traders can profit from market inefficiencies and price differences across exchanges.
And thirdly, many projects on Arbitrum offer staking rewards for holders of their tokens. By staking your tokens, you earn a percentage of the network fees or newly minted tokens as a reward.
Finally, you can provide liquidity to decentralized exchanges such as Uniswap and earn a portion of the trading fees generated on the platform. By providing liquidity to pools that have higher trading volumes, you can earn a significant return on your investment.
These are all great opportunities to make money with Arbitrum, and it's exciting to see how this network is providing users with new ways to earn passive income. So, prior to the token launch, Arbitrum was governed by New York startup Off-Chain Labs. But with the ARB token, the community will be able to participate in governance decisions.
Arbitrum is an optimistic roll-up scaling solution on Ethereum. Its goal is to ease congestion and gas fees on the Ethereum network. When a transaction is executed, it's sent to Arbitrum, whose throughput capacity is 7 to 10 times greater than Ethereum.
And since the Nitro upgrade, there has been an uptick in transactions on-chain, recently overtaking Ethereum in daily transactions. According to DeFilima, there is currently $2 billion locked inside Arbitrum-powered protocols compared to Optimism's $1 billion.
That's right. And decentralized derivatives platform GMX and exchange Uniswap command the most value on the network. Ethereum native dApps AAVE and Curve have also launched on the network, among others.
So, Nike, what does this mean for the community?
Well, rising usage only amplifies the need for decentralization. According to Blockworks research, ARB will allow for decentralized governance over the Arbitrum protocol, similar to Optimism's OP token.
Interesting. So ARB holders will be able to vote on all aspects of the protocol, including upgrades, inflation adjustments, as well as capital allocations like grants.
And almost 12% of the total airdrop supply will be distributed to Arbitrum users, with over 1% given to DAOs building on top of the network.
What about the rest of the tokens?
43% will go to the Arbitrum DAO treasury overseen by the protocol's community governance, 27% to the Off-Chain Labs team and future advisors, and 17.5% to Off-Chain Labs investors. The airdrop will distribute over 1 billion tokens to more than 600,000 wallet addresses. The minimum entitlement is 625 tokens, and the maximum is 10,250 tokens.
And those who hold ARB tokens will be able to participate in voting on essential decisions that affect the Arbitrum One and Arbitrum Nova networks.
It's interesting to note that the airdrop is an official move into a decentralized autonomous organization or DAO. This shows Arbitrum's commitment to decentralizing its networks and letting the community have a say in its ecosystem and technology.
Absolutely. And if you haven't checked your eligibility for the drop yet, you can do so on Arbitrum Foundation's official website. After connecting your wallet, you'll be notified if you're eligible and how many tokens you can claim.
And according to Arbitrum's Medium post, there were multiple qualifying actions taken into account to determine the eligibility of a user. These include bridging funds into Arbitrum One, conducting transactions during 2 distinct months, completing more than 4 transactions, and interacting with more than 4 different smart contracts, among others.
After distributing 12.75% of the total token supply to eligible users, the Arbitrum Foundation and DAO will be responsible for gradually distributing the remaining community tokens.
It's worth mentioning that investor and team tokens are subject to 4-year lockups. The first unlock will happen in 1 year, with monthly unlocks for the remaining 3 years.
This is all part of Arbitrum's plan to grant all sub-communities a voice and decentralize its networks. And it's great to see more projects embracing the principles of Web3.
Yes, it's always exciting to see how the crypto space is evolving and how these new technologies are changing the way we think about finance and governance.
Well, let's continue our news block with a discussion about the recent news from the Federal Reserve regarding the collapse of Silicon Valley Bank.
Yeah, this news has been making headlines lately. The Federal Reserve Chairman, Jerome Powell, has admitted that the regulator was blindsided by the collapse of SVB, despite it being under their watch.
Exactly. Powell even said that he knew right away there was going to be a need for a review. And now, the Federal Reserve has launched an internal investigation to look into the events surrounding the failure of SVB and how the Fed supervised and regulated the bank.
It's crazy to think that a bank like SVB could collapse like this. And the market panic that followed, leading to a $160 billion wipeout in its market cap in just 24 hours, is just mind-boggling.
And to make matters worse, the Federal Reserve has now announced an increase in interest rates by 25 basis points. This has sparked frustration from U.S. Senator Elizabeth Warren, who believes that Powell is a dangerous man to have in his job.
That's right. Senator Warren has been very vocal about her disapproval of Powell's policies. She believes that the successive interest rate hikes aimed at taming inflation have eroded some long-term bonds it purchased at near-zero rates.
And she's not alone in her criticism of Powell. Many are blaming the Federal Reserve's weak regulatory approach toward large banks in the U.S. over the last 5 years for the recent banking crisis.
It's definitely a complicated situation, but it just goes to show how interconnected everything is. The collapse of a single bank can have a ripple effect throughout the entire economy.
In our next news topic, we have an interesting story involving FTX, a popular crypto exchange, and Modulo Capital, a venture capital firm. Apparently, FTX is seeking to recover $460 million in allegedly misappropriated customer funds from Modulo.
Yes, that's right, Jane. And the twist in the story is that Modulo received a massive investment of $400 million from Alameda Research, which is FTX's sister trading firm, in 2022. So, the question here is, was there any wrongdoing on the part of Modulo or Alameda?
Well, according to FTX's claim, the investment from Alameda and Modulo was at the direction of Sam Bankman-Fried, who is the CEO of FTX. So, FTX is claiming that Alameda invested $475 million in Modulo in a series of transfers beginning in May 2022.
That's a big investment, and it gets even more interesting. On June 16th, Alameda entered into a limited partnership agreement with Modulo, resulting in Alameda transferring the aforementioned funds to Modulo in exchange for ownership of 20% of Modulo's Class A shares.
And now FTX is claiming that the investment was misused, and they are trying to recover their funds.
That's right. In bankruptcy proceedings, payments made to entities prior to the bankruptcy filing may be eligible to be clawed back and redistributed to creditors. And as per the settlement agreement, Modulo has agreed to repay $404 million in cash and will give up its claim to $56 million worth of assets held on FTX's crypto exchange. representing nearly 97% of FTX's initial investment.
It's all for today. Whether you're a seasoned crypto investor or just getting started, it's important to stay up to date on the latest developments in this fast-moving space. We hope you found today's episode informative and engaging. As always, thank you for tuning into our podcast, and we'll see you again soon with more insights into the exciting world of crypto and blockchain.